What is residual income? Well, residual income is used to refer to a lot of situations, but basically it's when you have higher income or more income as a result of your activities than you otherwise planned for or expected. So it's above what is expected in a given scenario. Now, the reason you care about this is primarily for purposes of planning so that you can allocate your resources effectively in the organization and to maximize ultimately your expected income rather than residual income being an unexpected event. Okay, so how is the term residual income used? Where does it apply? So it's applied in finance, it's applied in equity valuation, and it's applied again in personal finance, meaning that basically anytime you have discretionary income, okay, that's referred to as residual income. What we're focusing on primarily is in finance and in equity valuation. How is the term used? So to start with, in finance, residual income, the calculation for it is you take your controllable margin, and I'll explain this in 1 second, minus your average operating assets employed to generate a certain level of income, right? So the average operating assets employed or used up as part of that process, and you subtract the difference and then you multiply that by your required rate of return for the project. Okay, and ultimately, as long as that's a positive number, that gives you your residual income. So what is controllable margin? Well, that's basically the project's revenue minus its expenses. Okay, so you take revenue minus expenses and then you subtract from that your operating assets. Now, you can either look at the beginning and the end, or you can somehow try to keep track of your individual expenditures throughout of assets, and that's a difficult process when you have portions of assets expended as part of a project. That is, it has a continued life after that, but at least some of the value is attributable to it. So once again, you try to assess the value of assets attributable to a project. You subtract that from your controllable margin, boom, multiply that by your required rate of return, and that should give you your residual income for the project. Now, when it comes to equity valuation, valuing that value of something, right? You're basically taking your net income and subtracting your equity charge. So net income, we know what that is. It's income minus expenses. So what are you subtracting from it? Your equity charge is generally the total equity invested in something, the total value present there that you're trying to value, times the expected return on investment for that equity invested. So you put a certain amount of value in. If I invest $100 and I expect a 10% return, my required rate of return will be 10%. My total equity invested would be 100, right? So you get that percentage. You'd subtract that from your net income to see what your residual income again is. What did you make more than you expected? So once again, residual income really is used consistently across these various fields. It generally means when you receive more value than otherwise planned for or expected.